Good afternoon, ladies and gentlemen. Thank you for having me this afternoon at this fantastic event. My present today is a testimony that public and private markets are complementary and have the shared purpose to offer to entrepreneurs the right financing tool at every step of their growth journey. I'm Eric de Montgolfier, CEO of Invest Europe. I've been for 30 years an investor in private equity, managing and founding two management companies, and I've taken the mission of leading Invest Europe a little less than 5 years ago. Invest Europe is representing the VC growth, capital, private equity, and infrastructure sectors, as well as their investors such as pension funds, insurance companies, sovereign wealth funds, high net worth individuals, and more. Founded 40 years ago, Invest Europe is based in Brussels, where I lead a team of 32 people. Our membership is global. Our members all operate in Europe but come from 57 countries, including 42 across Europe. We have a balanced membership between VC, PE, including infrastructure and growth, as well as LPs, or investors. And lastly, more importantly, we represent 60% of the AUM under management investing in Europe. We also publish the most authoritative data on the industry, collected directly from market participants and covering 91% of AUM in Europe. And this presentation is based on these figures. Let's move now to slide 3. The PE industry manages today 1.15 trillion euros in capital under management at cost, meaning commitments plus investment as cost in portfolio companies. On the slide, you can see the exponential growth in fundraising experience in the last 15 years, reaching a peak of 195 billion in 2022, driven in volume and multiple by the buyout segment, but with the other segments' growth not too far behind. They lost a bit of market share, but ultimately the market has reached a level that was completely unexpected when we looked at it from 15 or 20 years ago. Fundraising, to be fair, has been more challenging since 2022 due to geopolitical, macroeconomic, and financial conditions, including the sharp rise in inflation and interest rates, leading to a lot of uncertainty, less exits, generating less distributions for our investors, limiting, as a result, their ability to commit further to the asset class. Conditions are now progressively coming back to normal on the back of an increase in transactions and exits and decisions by central banks globally to reduce interest rates. Private equity and venture capital form an increasing part of institutional investors' balanced portfolios, diversifying risk and return over the long-time scales that really matter to pension funds, insurance companies, and other long-term investors. They also care very much about ESG and impact, as we do, incorporating ESG into our internal processes, as well as at portfolio company level. Mathieu Caron from BP France will be more explicit about this aspect later today. As you can see on this slide, it's a busy slide, I'm afraid, their appetite for each segment varies a lot. To take two extremes, pension funds and sovereign wealth funds, for instance, have a strong preference for buyouts versus venture capital due to a perceived risk-return profile which is a bit challenging and ability to deploy capital at scale. Whilst government agencies and corporates are focusing primarily on VC, it represents 50% of funds raised, versus other strategies to drive forward innovation across Europe. Interestingly, if we look at fundraising with the geographic lens, commitments of institutional investors by region are even more differentiated, reflecting in part the maturity of each market, and in part the regulatory environment which can either incentivize or disincentivize institutional investors to allocate to the asset class. There are still a number of countries across Europe where it's actually forbidden to invest into private markets. If we now look at the origin of funds invested, 60% of investment comes from outside the European continent, roughly half from North America and Asia, and 10% from the UK. PE is therefore a net importer of foreign direct investment. In another slide that I've not included, being conscious of time, we see that the remaining 40% is invested by investors mostly into their own country, showcasing the barriers within Europe to invest cross-border that need to be lifted, an important objective for the upcoming Capital Markets Union. As long-term investors in businesses, private equity and venture capital are a cornerstone of Europe's economy and society, providing support in terms of expansion, transformation, such as the dual transition that we're going through, and crisis. Investment levels peaked in 21 and 22, but remain higher now than pre-COVID levels. And if I want to give you just one figure to remember, over the last 5 years, PE invested a stunning 576 billion euros in businesses across Europe, 85% of those being SMEs. This is an interesting slide because we cover two topics here. First, the PE industry is able to offer to each entrepreneur the right financial partner and shareholders at each stage of their journey, as illustrated on this graph, reflecting last year's data, from seed investments to buyout. So the process is very simple. You have a choice as entrepreneurs between a lot of different players based on the segmentation of the market, and you have also the possibility, if you believe that it's the right moment, also to go from one segment to the other. You will always find within private markets the right partner in one of those segments to help you in this journey. So as a consequence, more and more entrepreneurs tend to stay longer private until they reach a size or a maturity that makes a listing the best financing option. In the last 5 years, over 30,000 best-in-class companies have benefited from one or several follow-on equity investments from their private equity investors. And where do we invest? Actually, 50% of these best-in-class businesses are now operating in the ICT, biotech, and healthcare sectors, key, as you're all aware, for European economic autonomy and sovereignty. And it's not only true for VC, it's also true for actually private equity, meaning buyouts. One last feature that I really covered but is worth mentioning, I think, today, is actually the ability of PE to deploy capital seamlessly at portfolio company level in good times, supporting internal or external growth, as well as transformation, or in bad if needed, for instance, during COVID. For information, during the second half of 2020, at the worst of COVID times, 65% of the money that was deployed by our industry was actually to support their own portfolio companies and not to invest in new businesses, which I think is quite telling. But why? Because our fund models, the fund management model requires investors in PE funds to commit capital, usually over a period of 5 to 10 years, which is progressively drawn for investment by PE managers. So we started calculating a few years ago how much the so-called dry powder represent in years of investment, and the answer is a very stable number, on average between 3 and 3.5 years of past investments, which gives good visibility to entrepreneurs on their financial partners' ability to match their needs. So this is slide 10. One last, let me see, is it slide 10? Can't see the number. Yeah. So actually, when I look at this slide, it's quite busy and I won't communicate too much. As you can see, the title is quite self-explanatory. PE is not anti-cyclical, it's actually pro-cyclical because our businesses for a large part are actually following the same kind of trends that affect publicly listed companies. More interesting is the analysis made on the next slide about the exit routes. The exit routes that we have actually identify, those are in line with our historical data, and not surprisingly, trade sales and sale to another PE firm are actually the two main routes taken by our portfolio companies to exit, irrespective of the segment. And I must admit that IPO remained far too scarce as an exit route, which we believe is completely unhelpful from a performance crystallization as well as a strategic point of view. In amounts at cost, 13%, 10%, and 2% respectively of VC growth and buyout exits are through a listing on a public market. That's not much. And the situation, when you look at it from a global perspective, is no better, because if you don't look at amounts but also at number of companies, you see that the number of companies listed in 2023 represent approximately, let's say, 5% of 3,150 companies, which is literally nothing, and should be at least 10 times that level. IPO is an important exit route for our portfolio companies, so we are supportive of any initiative taken at European, EU, or national level to simplify listings, increase post-IPO liquidity, and reduce, if not eliminate, the present fragmentation of stock markets. And I truly believe that Euronext has something to do in this respect. When we look at the sectors that are represented at exit level, we see that the same key sectors we discussed earlier in the presentation, ICT, biotech, and healthcare, are overrepresented at exit level, always in the top three sectors, irrespective of the segment, from the VC, growth, capital, and buyout. Now, the elephant in the room, performance. The European private industry is generating impressive net returns, outperforming consistently international peers and public markets. As an illustration, and this is not a well-known fact except for their investors, European VC has delivered in the last 15 years a net performance on par or above its US and Canadian peers. You can see this on this graph. I drew a line before for the first 15 years, and afterwards, obviously afterwards, European VC was impacted by the bursting of the bubble in 2000 and had needed time actually to recover to get back to the right performance. And what is also very telling is the fact that this performance is actually expressed in euro as well as in US dollar. But perhaps more important in the context of this conference, PE net performance has delivered significantly stronger performance than public markets over the long term, which explains why institutional investors have reallocated massively to this asset class in the last 15 years. The difference is quite enormous, from 600 basis points per annum to 800 to 900. That's in comparing through the MPME methodology indexes across the globe to the performance of the relevant PE or VC asset class. But, and to echo Marta's comments, the private industry does not only create financial value, but creates also social value across Europe. Private equity and venture capital are major employers in Europe and create new jobs by investing in businesses, strengthening communities and society across the continent. I have extended my time for a few minutes, so let's maybe look at this slide that covers it mostly. We are employing close to 11 million euros in PE and VC-backed companies. That represents 5% of the active workforce of Europe. And we have created last year 7.2, we have a job creation rate of 7.2%, which is way, way above the average European job creation rate of 2% that you see reflected here. That's just enormous, and I've been tracking that data for the last 5 years, and I'm proud to say that that was the case every single year, including during COVID, which shows actually the kind of value that we can create globally for the communities in which we operate. You will be able to look at the figures in this presentation as it can be distributed to all of you after this event, so I won't go into the details. I can just safely say that when you look at this performance in terms of job creation, whether in terms of segment of the market, whether in terms of geography, including at regional level, we can see a replication of that superior job creation rate year in, year out, and have done that for the last 5 years, which is obviously something we do care about. So in conclusion, if there are only 3 takeaways to keep from this presentation, I would offer that PE has increasingly become the asset class of choice for long-term investors to access strong returns that help boost pensions and savings, while creating jobs in every corner of Europe at all investment stages. Second, entrepreneurs can find with PE a long-term partner at every step of their growth journey, and increasingly do so, as demonstrated by the overwhelming number of companies staying private for a longer period than 15 years ago. And lastly, I truly believe that public and private markets offer a differentiated value proposition to entrepreneurs and need to work collaboratively to ensure a continuum of financing, which will serve not only entrepreneurs, but also Europe's needs to finance innovation, the dual transition, and its economic sovereignty. Thank you.